$200,000 in investments in a used Toyota. People will call you broke. $0 in savings and a leased Mercedes. They'll call you successful. That's the world we live in, a place where status overshadows substance, and looking rich earns more praise than being financially secure. But here's the truth. Status is a trap that keeps people broke, distracted, and performing for approval instead of building for freedom. Here are 17 money truths to unfuck your financial life. Number 1. A financed car is not an asset. It's a payment plan on a depreciating lie. It drops in value the moment you drive it. That shiny new car you couldn't wait to get off the lot. It just lost 10 to 20% of its value. According to industry data, a new car can lose up to $3,000 to $6,000 in the first month alone, and you're still locked into years of payments. Interest turns a $40,000 car into $55,000 before you're even done paying it off. That's money you're spending to go backward. You're paying for image, not utility. And it doesn't make you richer, just quieter at traffic lights. Consider the math. A $40,000 car with a 5% interest rate over 5 years adds $5,500 in interest, pushing your total cost to $45,500. Add depreciation, and you're underwater before the first oil change. True wealth doesn't announce itself. It grows silently through investments or savings, not through a vehicle that loses value faster than you can say. Lease agreement. Debt, on the other hand, screams in monthly payments you can't ignore. $800 a month that could have been invested instead. Number 2. If your credit score is high but your savings are low, you're not doing well. You're doing what the banks want. A great score only shows you borrow well. It doesn't say anything about your net worth. Lenders reward debt, not discipline. They want you to carry balances because they profit off your excellent score. You can have no debt and be financially healthier than someone with an 800 credit score and $0 in savings. The system praises behavior that keeps you dependent on credit cards, on loans, on monthly payments. Don't mistake approval for success. A high credit score might get you a lower interest rate, but it's a hollow victory if your emergency fund is empty. Banks thrive when you're a reliable debtor, not a self-sufficient saver. Imagine 2 people. One with a 750 score and $500 in savings. The other with a 600 score and $10,000 saved. The latter is better off, yet the system celebrates the former. Break free by prioritizing cash over credit. Number 3. Middle-class mindset. I'll save what's left after I spend. Wealthy mindset. I'll spend what's left after I invest. Saving is not optional, it's the foundation. If you only save what's left, you'll never save enough. Automate investments before you see your paycheck, before lifestyle creeps in. Because lifestyle inflation kills long-term security. You get a raise and suddenly the nicer apartment, better car, or upgraded phone feels necessary. But the habit matters more than the amount. If you don't pay yourself first, someone else owns your future and your freedom. For example, setting aside 10% of your income into an index fund before bills can compound into significant wealth over decades. A $500 monthly investment at 7% annual return grows to over $300,000 in 30 years. Contrast that with saving $500 after spending, which might never happen if expenses rise with income. Discipline trumps desire every time. Number 4. Most people don't have a money problem. They have a spending problem disguised as lifestyle. You don't need daily Starbucks, just caffeine. That $600 habit adds up to $2,190 a year, enough for a down payment on an asset. Designer doesn't mean durable, and Ubers, they add up faster than rent if you're not tracking. Convenience debt is the slowest poison. It feels harmless in the moment but compounds into chaos. Your expenses reflect your values. Choose them carefully because they silently shape your financial future. Take a $10 Uber ride 5 times a week. That's $2,600 annually. Over 10 years with minimal interest on a credit card, it could balloon to $3,500 or more. Small leaks sink big ships. Audit your spending. Every dollar should serve a purpose, not just a preference. Number 5. The rich use debt to buy assets. The poor use debt to look rich. Business loans build income. Mortgages can create equity. These are strategic forms of debt. Leverage for growth. Credit cards fund liabilities. Lifestyle loans are chains, not choices. Debt is either a ladder or a leash. Pick wisely. Use it to climb, not to choke. A real estate investor might use a $200,000 mortgage to buy a rental property, generating $1,500 monthly profit. That's leverage. Compare that to a $10,000 car loan for a luxury vehicle that earns nothing. The difference lies in intent. Debt for income versus debt for image. Number 6. Nobody got rich on cashback points. Credit card points bait overspending. The 1% cashback isn't worth 18% interest, it's not even close. Travel rewards are not equal to financial security. They make you feel good but don't build wealth. Pay the balance or don't play the game, because rewards are illusions. And the bank always wins. A $1,000 purchase with 2% cashback nets $20. Great, until you carry a balance and pay $180 in interest. The bank pockets the difference. Skip the points chase and focus on paying off debt or investing that money instead. Number 7. Most people plan more for a vacation than they do for retirement. They book 2 weeks in Bali but not 20 years post 60. Retirement isn't an age, it's a cash flow number. Social Security won't save you. Investing early buys decades of freedom. The future isn't promised, but it needs a plan. And that plan starts now, not later. A $5,000 vacation feels tangible, but $5,000 invested at 25 with a 7% return becomes $75,000 by 65. Most skip this math, prioritizing Instagram posts over financial posts. Start with a retirement calculator. Aim for 25 times your annual expenses and invest monthly. Number 8. Your emergency fund isn't optional, it's your financial seatbelt. Aim for 3 to 6 months of living expenses. Keep it liquid, not in stocks. When emergencies come, and they will, timing isn't on your side. Peace of mind is worth the effort. If you can't survive a $1,000 emergency, you're walking a tightrope without a net. One small fall can take you all the way down. A $3,000 emergency fund for someone spending $1,000 monthly covers 3 months. Without it, a car repair or medical bill could force debt. Stash it in a high-yield savings account. 1% interest beats 0% under the mattress. Number 9. You'll never out-earn bad money habits. A $250,000 earner with $240,000 expenses is still broke. The problem isn't income, it's lifestyle. Money problems scale with income if you don't fix the habits. And habits compound, good or bad. It's not what you make, it's what you keep. Lifestyle creep is how 6-figure earners stay poor, stuck in cycles that look good on Instagram but feel empty in real life. A $50,000 earner saving $10,000 annually outpaces a $200,000 earner spending $190,000. Habits determine destiny. Track every dollar to break the creep cycle. Number 10. If you don't own equity, you're working for someone else's dreams. Stock options matter more than salary. Ownership means you benefit from growth, not just hours worked. Build your own business or own part of another. Hourly income has a ceiling. Equity doesn't. Learn to earn without trading time, because equity is how employees become escapees from paycheck dependency and corporate chains. Owning 100 shares of a growing company that doubles in value beats a $20 per hour raise. Seek equity in startups, real estate, or stocks. Freedom follows ownership. Number 11. Most people scroll more than they study. TikTok doesn't teach tax strategy. Your feed is not financial advice. Read more than you swipe. Learn before you earn, or lose it all. Attention builds someone else's wealth unless you redirect it. Every hour you give away is an investment. Make sure it's earning you something back. Spend 30 minutes daily on a finance book like The Millionaire Next Door instead of Reels. Knowledge compounds like money. Invest in it. Number 12. No one is coming to save you. Not school, not your job, not the government. Schools don't teach money. Jobs won't make you rich. Inflation eats stagnant income. Ownership is your only parachute. You are your own bailout. Act like it. No one's handing out rescue plans, so build your own. With 3% annual inflation, $50,000 today is worth $37,000 in 10 years. Relying on a job or government checks ignores this reality. Own assets to outpace it. Number 13. Savings don't make you rich. Investments do. $10,000 in the bank earns 0.01%. $10,000 in index funds earns 7 to 10% over time. Learn the basics. Stocks, ETFs, real estate. Don't wait for a windfall. Time in the market greater than timing the market. Money sleeping in savings is money losing value. Don't let it nap, make it work. A $100 monthly S&P 500 investment at 8% grows to $125,000 in 40 years. Savings stagnate, investments multiply. Start small but start now. Number 14. Poor people count money in hours. Rich people count money in assets. Time for money is a trap. If you have to be present to earn, you're still stuck. Assets earn while you sleep. Buy things that pay you. Stocks, rental properties, businesses. Your goal, passive greater than active income. If you stop working and your money stops flowing, you don't own wealth. You own labor. A rental property netting $200 monthly beats $20 per hour at 40 hours a week. Shift to assets. Time becomes yours again. Number 15. If your money habits aren't written, they're wishful thinking. Budget what you track. Track what you spend. Plan what you keep. Automate what you invest. Clarity equals control. Without a system, you're leaking wealth. You don't need to be perfect. You need to be consistent. Every plan starts with putting it on paper. A simple spreadsheet tracking income, expenses, and investments beats vague intentions. Review monthly. Adjust. Refine. Repeat. Number 16. Being rich is not the same as acting rich. The wealthiest dress average. Flash attracts taxes, fraud, and fake friends. Rich people protect peace, not just portfolios. Private is powerful. The loudest person in the room usually has the least to lose. Move in silence. Win in silence. And stay rich in silence. A billionaire in a $50 t-shirt avoids the spotlight that invites scrutiny. Quiet wealth lasts. Flashy status fades. Number 17. Your first $100,000 is built with sacrifice. Not shortcuts. Say no to nightlife. Cancel the subscriptions. Learn a high-income skill. Drive a beater if you must. Discipline today buys options tomorrow. No one gets to $100,000 casually. You earn it. One deliberate choice at a time. Skipping a $50 dinner weekly saves $2,600 yearly. Invested at 7%. That's $10,000 in 10 years. Sacrifice builds the base. Shortcuts collapse it.